Okay, I will get started. Thank you all so much for joining today. This is part of the CWDL webinar series on key mortgage topics for our clients and friends in the industry. Today, we're discussing the current state of the secondary market, and we're extremely fortunate to have guests Jeff McCarty, Director of Hedging and Trading Products, and Jim Glennon, Vice President of Hedging and Trading Client Services, both from Optimal Blue. We were also fortunate to have a last minute add. Tony Paciente is the account manager and an MSR expert also from Optimal Blue. CWDL's own Dustin Pfluger will be moderating the discussion, touching on rates in 2024, hedging strategies, the MSR market, and what lenders can do to help manage margins. Just a couple of housekeeping items. We like to keep this as interactive as possible. So if you have questions, type them in the chat. We'll do our best to get to all of them. If we don't, we'll circle back up with you. Other than that, I'll turn it over.
Okay, well, thank you, Casey, and thanks, guys. Thanks, Jeff, Jim, and Tony for all being on here. We value your input. What you have to say here. We haven't done one of these in a while, so
yeah.
I guess just starting off, the topic points Casey already went over, but just wanted to kind of start off with just a kind of a general market update. What y'all have seen over the last 6 months or so. I know Jeff and I first joked that this is probably the most consistent the market has been, or lack of volatility the market has been in a couple years. So I guess with that, just why don't y'all each, all three of you maybe give just an update on what do you think the market's doing, where you think we're at, that kind of thing. So go ahead and jump in. Jim, you're on screen, so why don't you jump in?
I'll kick it off. You're right. The last 12 plus months have been pretty boring, I think, in the market until you get to early July, though. Like the last couple of months have become a little more volatile, especially if you go back to, I think it was the first week of August. We had an unemployment number on a Friday, and then the following Monday, a lot of you will recall there was a pretty good sell-off in the equity markets that was triggered partially by that bad unemployment number. There was also some noise around, like some technical discussion around carry trade of the Japanese yen and just some other trades that started to break down during that period of time. And there was a 7-8% sell off in the equity market. Rates dipped like really hard during that week and kind of continued a run lower. So we started to see some pretty good pickup in lock activity, some pretty good pickup in margins during that time. So it's starting to get a little bit more exciting. I think volatility can sometimes be our friend, at least in the mortgage business, because you tend to get into uncertainty. When you have uncertainty, you have people buying bonds. You have people buying bonds. You have rates going lower, right? Looking for safety or guaranteed returns or whatever that is. So in a nutshell, that's kind of what's been going on the last couple of months. That's been, I think, adding some positivity, some optimism to the industry. Anything you would add to that, Jeff? Just high level macro?
No, I mean, looking at over the past couple of months, like you said, since the beginning of the year, we really had super stable rates, right? You're just looking at mortgage rates, our OB mortgage market index, from beginning of the year through beginning of August. I mean, rates moved within an eighth of a point range, right? Just not bouncing around at all. And then around that time frame that Jim discussed, we've fallen off in our average conforming 30-year rate has fallen off over really around a half a point, I guess probably say a little bit over a half a point. Mm-hmm. Right, so we're in the high sixes for average rates being originated, and now we've fallen to towards the low sixes, 6.25 and below on the Govy side.
Yeah, I mean, many of y'all follow the Fed, right? I think there's always a lot of questions around how does Fed policy actually influence mortgage rates? And the Fed hasn't done anything different over the past couple of years. They basically held rates steady, right, after a long time of increasing rates. But a big thing they've done in the past couple of months is they've very much changed their tone. All right, so they've admitted that I think the quote was, "The time has come for policy to change," or something along those lines. So they've all but guaranteed that we're going to see rate cuts from now through the end of the year. There's still a lot of debate on how much those rate cuts will amount to between now and January. The consensus has been like 3/4 of a point to a point through the rest of the year, which is potentially on the heavy side. Honestly, I don't, some would say there's not a very good reason for the Fed to act any more than maybe a quarter per meeting. I believe there's 3 meetings left this year. But a lot has to happen. A lot could happen between now and then, right? If the unemployment numbers get a lot worse, if the inflation numbers continue the way that they are, continuing getting closer to an actual 2% inflation rate, you could see them cut quicker because they've been very restrictive for a very long time, so that they know that they've had their foot on the brakes potentially too long, to where they wouldn't want the opposite effect, where prices start to actually go down in some areas, right? That can be damaging to the economy. Some would say more damaging than what inflation has done. But I think a big thing to remember for those who don't really closely follow prevailing interest rates, especially mortgages and treasuries, is that the day that, like next week is the meeting, next Wednesday is the Fed meeting. That day, if the Fed cuts rates 25 or 50 basis points, mortgage rates are not going to go down a quarter or 50 basis points, right? There's already an assumption that that's going to happen, or something in the middle, call it 3/8, could be your guess. So that's already been built into the market, essentially. That's why you're seeing yields drop over the past couple of months, because it's in anticipation of that number. So if it comes in at a quarter, market might stay the same. Rates might even tick up a little bit, because some people were betting on 50 basis points, or the opposite, right? If they cut 50, you might see rates trickle down a little bit, because some folks were betting on that 25. So it's just the big thing to think about with the Fed, is their tone, but also what they and some of the some of the pundits in the industry will have you think is going to happen in terms of rates. That's probably already going to be mostly priced in to the market, so you're not going to get an immediate reaction.
So with that, that's a good kind of just transition or just a talking point here that I was going to ask. I mean, there's been a lot of talk over the last couple of years of the, I don't know the exact term, but the spread between the Fed fund rate and the 30-year mortgage rate, and how it typically tracks. And there's been a tightening of the spread. So how is that? I mean, I guess just give us a little background on how that's impacted the industry. What you think that's going to look like going forward if rates do start to drop? Is that spread going to stay about the same? Do you think it's going to go back to what we've seen historically? I mean, what are your thoughts there?
Yeah, I mean the Fed funds it's very short term rate that you're comparing to a 30-year rate, right? And for the last couple of years, that very short term rate has been very artificially high, because it's being influenced by policy, not by actual supply and demand. Whereas the longer end, the 10-year, 30-year, is being more influenced by supply and demand. So the conventional wisdom, I believe, would be, as the Fed lowers rates, you're going to see some reaction on the longer end, 10 and 30-year, but you're going to see the yield curve start to get steeper. So when we say yield curve, we mean the kind of the continuum of, as you go out from short-term rates to longer and longer rates, how high, what are those rates relative to one another? And right now we're almost completely flat. Like if you're borrowing for 3 months or 30 years, like your interest rate's almost exactly the same, which conventionally is not normal, because you have this artificial push on the short end. So I think you're going to see the Fed funds rate drop, and 30-year mortgages are not going to drop to the same extent, is the short story, right? If Fed funds rate goes to 2, you're not going to see a 3% mortgage, in my opinion.
Okay.
But you may see the spread that a lot of people watch is the spread between the 10-year treasury yield and the 30-year mortgage, which has a lot more to do with demand for mortgage assets versus demand for treasury assets. And that spread's been wider than historical over the last few years for a lot of reasons. Some of it was the regional bank drama a couple Marches ago. Some is just generally because the prepayment risk on a mortgage asset is higher than like a treasury asset, because people refi before the US Treasury does, right? So we hope to see some compression there as rates go down. and that would bring, I think, a lot of relief to the mortgage industry.
Got it. Oh, well, perfect. Jeff, any thoughts on that or anything before we jump into some other stuff?
Jim covered it pretty well. I mean, yeah, we have just kind of gotten back to this had a positive, normal, a little bit more normal yield curve. People have a lot of different interpretations of what that means. I've seen some things about, people always talk about inverted yield curve as kind of, a predictor of a recession. But then, so some people are excited to see that normalize, but then other people are saying, well, actually, you get inverted and then you go back to normal, and that's when the recession actually comes. Watching that closely, of course, nothing has been normal the past several years, so it's really hard to kind of follow these, and then that follows along to what Jim ended on there. Exactly what is a normal treasury to mortgage rate spread. Again, just nothing normal about what we've been through since the for the past 4.5 years, from all-time lows to 7.5%, 8% mortgage rates, and then starting to come back down.
Yeah. It's been a wild ride. Yeah, it has. I mean, I think we all about entered the industry about the same time, and it's definitely been an interesting, but the most interesting I've seen the last few years. So just back up just a little bit before we get into kind of just execution hedging topics, just on state of the industry overall. I know Jim, you were out at Western. Tony, I don't know if you were, but I know Jeff, you were at home in a chair somewhere healing your leg. But I mean, just overall, it seems like the mood has come back a little bit. I mean, that's at least what Western felt like. It just seems like that a little bit. I mean, any other thoughts or trends you've seen in the last few months? I mean, I'll tell you, going back even all the way to May, the TMBA annual convention, it seems mood has come back. It's a little bit more positive. It's people see a light finally here that so I mean, Jim, any other common things you heard at Western, or anything else you want to talk about, just kind of overall industry trends?
Yeah, I think every industry conference we've attended for the past year, it seems like each one there's incrementally better mood. Some of it is easing into a new normal, right? It's mortgage banks have right sized. They've straightened out their capacity. I think, knock on wood, the feeling is we've hit the bottom, right? And that probably happened sometime last year in terms of volume and a cap and rates and all that, and the negative stuff, layoffs and all that, right? So yeah, a lot more optimism at Western. We had just come off of that rally that was induced by the change in the Fed tone and the bad employment numbers and some of the volatility in the market. And even the economists, the MBA is back to projecting a 20% increase for this year, versus it had been 22 and then it had gone down to like 7, 8, 9, and then it gone back up to 20, just with some of this activity, hoping to free up some refis and maybe even a last quarter, push to the purchase market. I'm trying to think of what else we were hearing. I mean, you probably read, and you may have read in some of the industry media that previous quarter, second quarter of this year was the first quarter that mortgage banks made money on average.
On origination, on pure origination stuff, right?
Yes.
Yeah.
So that's obviously a good sign for longevity and for survivability of the rest of this year. And that was a year ago at that same conference. The motto was survive until 25. It was a little bit defeatist, but it's playing out exactly like that, as folks have made it through this year. It looks like fourth quarter could actually be pretty good. And then, a lot of projections, again, from economists and from people at the conference were thinking that rates will be quite a bit lower this time next year, which, if the rate path continues and the Fed kind of holds to their current rhetoric, and we don't see a really good labor market somehow, we don't see a reemergence of inflation, just logically it feels like it should happen. But I think
It seems to. I mean, one common theme we've seen a little bit too is this. Consolidation's still out there. It
Mhm.
does seem like it's slowed down some, and definitely, I know what's for us it's slowed down is the people that have just kind of shut their doors. I mean, we haven't seen that in 6 months or a year. I mean, there was a time there when I'm sure y'all were the same, that there was
Mhm.
time there was like every week we'd get a call that was like, hey, we're shutting our doors, or basically fire sailing. We're basically just giving this, company away to another company that thinks can, turn it around or whatever. And it seems like, that's kind of, gone away. Now it's really true acquisitions again, or something like, true consolidation again. I mean, really, it's not this fire sale type stuff or people shut. I mean, I mean, are y'all seeing similar stuff? I mean, it seems like y'all
Yeah,
are.
yeah, I think so. I mean, we were, you know, end of last year, into this year is exactly what you said. I mean, it was kind of constant
Yeah.
going out of business for consolidations. There's a few that are still coming through here or there, but I don't think people are as desperate. They do see the light at the end of the tunnel. So yeah, hopefully again we are kind of off the bottom
Mhm.
in that regard.
Yep. And then you made one comment over here in your deck that I saw this an interesting one, because I think we've kind of seen the same thing. It's just that the wholesale market continuing to increase, brokers growing. I mean, truthfully, we've seen a lot of like broker to banker type mini core type things emerging. It seems like on our end, it seems like every day we get a call from somebody that's like, hey, I was a broker, I'm trying to go back. I mean, what are your thoughts on that? I mean, you made this comment over here, I just want to get you digging a little bit more on what y'all are seeing on that side.
Yeah, I mean that's been one of the themes that comes up. It's really been an underlying theme since the great financial crisis, right? Brokers all but were extinct after the financial crisis because a lot of the legislation and regulation was geared towards brokers, or at least I think came down on them a little bit harder, or at least was more difficult for them to navigate. Legal costs went through the roof, so being a kind of a garage broker just didn't work anymore. So a lot of folks went to the banker side of the business. But since then, there's I think just the nature of wholesale lending still has a place in the industry. So it's continued to grow very slowly. But when there's times like right now, there's a thought. At least this is what folks were saying, and I've heard say it at conferences and just in frank discussions, is that there's, especially if we get into a refi market, the broker side of the business might be able to move quicker, might have more access to rates that are slightly lower, might have more flexibility, might have more products at their disposal to really capture a lot of that business more quickly, which is what they may need to do. Like, if we get waves of refis here in the next couple of years, they may be short lived if we have volatility. So there's a thought there that percentage of wholesale business really uh, accelerates. I mean, it's not going to go to 80% or anything like it has been 20 years ago, but it could accelerate in its growth over the next couple of years.
Okay. Okay, well, I mean, changing tunes, jumping on or moving on a little bit. I mean, just now, kind of getting into the whole, what I know you two do best and specializes, and Tony will get to MSRs here in a minute, but just, talking about like kind of the execution and the kind of the hedging side of the business, the mandatory side of the business. I mean, going back a couple years and just going forward. I mean, any strategy changes y'all have seen? Anything you guys, y'all have seen different, recommended? I'm sure y'all have seen y'all's pipeline of customers drop off because there was probably a big surge of customers for a while that probably shouldn't have been delivering mandatory on a normal, like on a normal market. But I guess just overall, I mean, any hedging strategies y'all have changed? Anything you're looking forward, looking into the future on what you're preparing for, that kind of thing?
Yeah,
Go ahead, Jeff.
yeah, I mean, just on the execution and loan sale side, it's in spite of consolidation we haven't seen a ton of consolidation on, say, the correspondent side, and Tony will talk about kind of MSR buyers, and that certainly feeds into the secondary market. But right there, it's still pretty robust, right? We're not losing any meaningful liquidity on the secondary market in terms of loan sales, right? We've got we've had a few people consolidate, a few servicers consolidate, but still plenty of buyers out there Um, it's still an attractive asset. We've got clients selling to 15, 20 aggregators, plus several servicers. I think technology makes all of that easier and easier, right? And just kind of streamlined guidelines. It's hard to make an argument at this point to not add another, or why you wouldn't want to add another buyer. It's so easy to add another buyer from a setup perspective. You may have a few difficulties here or there with a particular buyer, but it's usually something you can work through. So you're always going to have you should always have a competitive bid on the loans you're selling, whether it's co-issue through the agencies against your own retained execution, or you're selling everything to the aggregators. There's plenty of outlets right now. And that's been the way, it's really been that way, for the past several years. And just luckily that part of the market has not changed, because that's a part of the market that's hard to hedge, obviously. Where we've seen in other years, if you see a lot of people exit the market, you can't hedge that, right? So we've been watching that closely, and luckily we haven't had to deal with that.
Right. The buyers start to control the market like we saw after the financial crisis. Again, that was, call it 2010 through 2014. That was kind of what we were dealing with, 3 or 4 buyers. And then all these buyers came into the market. And then there was a disruption during the very early days of the pandemic, March, April of 2020. But even after that, it was, it's been a very lucrative, liquid business to be in, selling loans to a large stable of aggregators. I mean, looking forward, right? So we have been spending a lot of time over the past 6 months talking to our clients about what happens if this rally continues, right? What's the hedge strategy, or what should I be thinking about in my hedge strategy there? And there's that's a playbook that's a little bit dusty, because it's been 4 years since we've had a decent rally in the market, and that rally was unlike any other, as you remember, right? But if we get a prolonged year or two where rates are kind of consistently dropping, which is exactly what this market would want, kind of the inverse of what happened in 22, which was the rates were just slowly going up and kind of crushing the industry. What do I need to think about? How can I make the best of that and not lose opportunities? So it's things, I've got some notes here that we've talked to clients about, and it's things for all of you just to bring back to your businesses and make sure that you're focusing on. But it's cash flow. A lot of you are finance folks, right? When you've got a flat market like we've had the last year and you're hedging, you don't worry so much about cash flow. You don't have the disjointedness in your cash flow that you otherwise would in a volatile market. You've got loans getting sold every month, trades settling, and they're all settling kind of near the money. You get into a rally, right? You're going to have loans selling each month for huge gains, and then you're going to have hedges that are likely going to sell for some losses, because that's the nature of hedging, right? If you're hedging yourself neutral in a sell-off, your hedges are making money. In a rally, your hedges are losing money. But again, you're going to have loans get purchased in September. You may not realize some of those hedge losses till October. So you have to think about that. You have to plan ahead. Don't go out and buy a boat just yet. You're going to have to pay for some of those losses next month. We continue to coach clients on what Jeff was just talking about. If the market and volume expands, you may even want to look at expanding the diversity of your takeouts. You may have 15 investors now. There may be an opportunity to have a 16th, 17th, and so on. You may want to get into additional executions. Maybe you're not doing co-issue yet. Maybe you're not retaining servicing yet. That's something almost everyone should look at if they haven't, because that's what burned a lot of folks during the pandemic. Was the aggregators had to take their foot off the gas because of capacity. So their margins ballooned out. And if you weren't retaining servicing, you had to sell servicing reliefs to these investors, right? But our clients who were approved with the GSEs were able to liquidate and retain servicing and actually over time make a lot more return on those assets versus having to sell them out the door just to keep the turbine going. So, and same with broker dealers. Add a couple extra broker dealers, because we all have seen margin call issues over the years, and that will happen again. We were not going to have March 2020 margin calls. I'm fairly certain, again, unless there's a pandemic or a war, but the more dealers you have, the more you can spread out those buffers and that risk, and you will have, just by math, you will have less dollars out the door for margin calls, especially in the days of 4210, which we're in today, which means regardless of the dealer, minus a couple of them, most dealers are going to charge you margin when you hit about $250,000 in exposure.
So really, it's diversification is the future, is what you've talked about, whether it's broker dealers, investors, other products you can offer, whatever.
On the execution side, absolutely. And then internally on the policy side, it's margin management, like active margin management becomes even, I think, more important. Some think that when the market is kind of tight is when you really are focusing on margin, and you are, but as the market rallies, you're going to have opportunities to build more margin in for your originators or for your borrowers, and for good reason, right? You're going to need reserves for things like renegotiations that come up in a rally, right? I locked my loan today. 2 weeks from now, CNBC comes out with a story that rates have dropped 50 basis points. That borrower is coming back to me and saying, I need a lower rate, right? That's going to come out of the company's pocket, but we don't want that borrower to walk away. So we need a reserve for that. There's going to be probably more EPOs, early payoffs, that investors are going to come to you for. You need a reserve for that. So it makes sense to build in more margin. And when the market is volatile and rallying, you have more opportunity to build more margin in and still be competitive. The key there is to have good data, good market data, to compare your pricing to your competitors, right? So that you can ensure that your pricing is competitive, but not too competitive. It sounds simple, but it's actually a pretty hard thing to put together. But if you have the right data, you could be pretty successful at setting that price in kind of an optimal range.
So
anyway,
since you're talking about margins, margins compressed real tight there for a while. Have they the gross margins, have they come back some? What are y'all seeing there? Just since we're on that topic, what are have they come back some? I know they're not probably back to what they were, but kind of where are we at in the market on that type thing?
Yeah, what would you say there, Jeff? Too early to call, but
yeah, I think people just starting to consider what Jim was talking about. So we're just starting to tick up. I think everybody's just ready to pull in as much volume as possible at the margins you're operating at. But just starting to creep up. You can kind of pick some spots where you're going to get that volume regardless, without upsetting your loan officers, and pick up a little bit more. So I think that's probably a little bit more wishful thinking, but I think we will start to see it to some degree. Just haven't seen too much of it yet.
Got it. Okay. Back to your comments, Jim. I'll make a side comment here. You talking about March of 2020. I can still remember calling Jeff. I just come home, sitting in my bedroom, working from a desk. I'm calling Jeff, and I thought I understood this enough to explain. Yeah, I thought I understood it enough to explain to people. And I called Jeff. I don't think I talked to you, Jeff, in a year or something like that, and called you, and I was like, what is going on? I have no idea what's even happening here. And so it was a fun time. I can remember it was even a dark day and cold. It was a fun time. Anyway, so I guess last kind of topic or last kind of question on this piece. Overall, minus these little blips and rallies and stuff like that we've had and looking for it. Have y'all seen over the last 6 months or so? People have accepted this is where kind of rates are, and the pipelines kind of come back some. Or like you said, we probably reached the bottom sometime last year, so that probably means that pipelines have come back some. But what do you just overall on pipeline size? What are y'all seeing? Trend wise.
Yeah, we're seeing modest increases in pipeline size for sure. I think some of it is, very well could be borrower psychology. Borrowers are in a mindset now that rates are going to be higher for longer. The purchase market has been up and down, obviously, but the refi market has started to pick up, and it does feel like, some of it is rates and some of it is mortgage lenders coming up with more creative ways to originate loans too in this market. But
yeah,
rates
I think
go ahead, Jeff.
No, I'm probably where you're getting to. Sorry to cut you off. But yeah, I mean, I think even before the rate drop of a couple months ago, we were starting to see an increase in volume for the reason Jim said. I think people were just kind of normalizing themselves to the higher rates, even in the spring and early summer. And we have seen a little bit more of an uptick in new locks over the past couple of months, but not a significant uptick for the half point decrease in rates yet. They kind of already increase in volume almost already came before the decrease in rates, which was an interesting dynamic. You kind of think about just what Jim said, right? People getting used to higher rates, and now they see rates lowering, still not enough for other people to get them off the ledge, right? A lot of dynamics going into the psychology of borrowers here.
Got it. Okay. Well, great. Let's jump in, Tony. Now it's your time to shine. I know you've been quiet over there for a little bit, so we brought you on last minute to kind of chime in here on the MSR market. So thanks, Tony, for jumping in and being here. I guess just again starting off just generally overall, what is the MSR market looking like? I mean, what are your thoughts there?
I think I think there's been a lot of anticipation in the market, right? When we like we've been talking about, rates seem to have kind of like settled in for a little bit. People kind of took a deep breath, wait, and then kind of waiting to see when are those rate cuts going to happen. And there was a lot of movement over the past few months where aggregators were really paying up for MSR in anticipation for this potential rate drop, to make a play on recapture, and that's been like a big thing in the market, in the MSR market, is building up the portfolio to then be able to turn around and try and recapture as the rates drop. And it was funny what Jeff had just mentioned about seeing the pipelines increase a little bit before the rates had started rallying and dropping. There's probably still a good amount of people that are kind of waiting on that trigger too. Like, do I wait for this drop in rates, or do I wait a few months, kind of like see where rates are? So I think we'd see some more pickup there, and I think with that, you potentially will see these servicers taking more advantage of recapture and pricing recapture into their MSR valuations.
Perfect. So on the kind of on just the topic of values and stuff like that, I know especially at year end, because we're doing all the audits and stuff like that. I mean, it seemed that the market value was probably higher than fair value was higher than what actual market value was out there. So what trades were going for. I mean, is that? I mean, truthfully, I made that comment earlier, Jim, to you about that the originations are finally come back profitable. I mean, I think in our client base, people that had servicing and a decent book of servicing, they became profitable a little bit earlier, but it was all basically built into that fair value adjustment. It was basically
right.
like unrealized, not even. I mean, kind of a risky adjustment, because if you sell it for cash, probably not going to realize there. I mean, I guess what we're seeing there. So
typically, in a run up in rates that we had over the past 2-3 years, the models will kind of be ahead of the market values, right? So the fair values will usually be a little bit more richer than we're seeing in the market, because buyers are going to wait until they get some solid prints of CPRs to then pay for them, right? So models will project out a little bit higher value. Buyers will kind of wait to see those CPRs stick before going in and paying up for them. I want to say it was probably 3 years ago at the IMN servicing. It was talked about almost like hitting, because there's an initial good initial push of people selling MSR, buyers coming in, and kind of hitting like a mult cap at the time of like 5, maybe 5.5, where, the value, the mults in fair value were up around like the 6 range. I think more recently this year, like after year end, kind of in the first quarter, that kind of like jumped, that kind of flipped a bit with people gearing up with this recapture play where they were paying up for MSR. So that market value started to touch more of those higher mult ranges than were before. But that's typically not how it goes, right? Typically it's the models will be higher than what you see out in the market. And the risks have really like changed shape over these past 3-4 years. We went from the low rate period of COVID, where your float income, your escrow earnings, remittance float earnings made up like maybe like just 5% of that MSR value. With the sell-off in rates, right now, a heavily escrowed portfolio, you're looking at north of 20% of that MSR value, coming from that float income. And that dynamic's going to shift again as we start, decreasing in rates. You'll start seeing the float income not be as big of a piece, and the risk, if you think of like duration and dollar sensitivity DV01, where your majority of that sensitivity is in your model, and where you model out the float income, it's going to start shifting back towards the prepayment risk, right? Because as rates have gotten to a certain point, for at least for older portfolios, you're getting to a point where on the S curve, rates could keep going up and up, but there's your prepayment sensitivity isn't going to budge, because at this point there's really no reason for, let's say, a person at 4% rate, when rates are 7, and then go up to 8 or 9, that prepayment sensitivity is going to be pretty flat, whereas your sensitivity on your float income will still keep going as rates go up. So that's going to start shifting back to where your rate sensitivity, if you think of it like a key rate duration, maybe out of, let's say, the 5-year swap rate and into more of the 2 and 10-year swap rates, which make up a large majority of like models prepayment projections through their projected retail rates. So it could be a change in hedge strategy, at least for MSR, people holding MSR, coming down the line because of that.
Yeah. Yeah, that fair value to market value thing has been, I'll tell you, it's been interesting, over the last year. It's, again, we've had some clients that have gotten into some tough situations because, they may have valued it, I don't know, a 6 multiple on their books, but they need the cash, they need it bad.
Yeah.
So.
And that brings up, it's an interesting kind of point, a little bit of a conundrum for, I think, for people holding the MSR, because you have a few different thoughts of how you want to manage that MSR value. If you are someone who's not expecting really to sell your MSR, you may gear your model towards something that you can more easily hedge, right? So your financials look better. So you could have an issue though when you go and turn around and being caught in a spot to have to sell it, where your values may be too high. You may have been more easily able to hedge it, but your values may be too high, and you kind of take a hit from it. There's other clients and other MSR holders that really just want that realistic market view in their model. So if it does come to a time to sell it, they have that like a better view of what the true value is.
Oh yeah, no, for sure, and that's what we kind of got into. in the year, I was mentioning this to Jeff and Jim. I mean, the technical accounting is, fair value, and since it's a level 3, asset, it's, a discounted cash flow type model, but at the end of the day, we weren't for the most part telling clients no if they wanted to be more conservative and bring that down to a market value, because we knew what it meant long term.
Exactly.
Yeah. So just overall, I mean, and just in sales in general, I mean, is the market up, or is the like how active is the sales market right now for MSR?
It's still decently active. What's the interesting shift is, and this was happening, I think, towards the end of last year even. You're seeing like smaller deals getting done, like maybe deals even under like $1 billion, where before it was a lot larger deals. It was smaller deals getting done. I think that was people being maybe more strategic in their position. It could also just be because of risk-weighted capital concerns, at year end. So it was interesting to see smaller deals, but at the same time, that meant there's a little bit more focus on, the underlying collateral, right? FICO scores, LTV, where those tranches really, really look like for these smaller deals. Because at the same time, with some of these aggregators really paying up for MSR, that market price was going up too. So it was more discerning purchasing of collateral also.
Got it. Okay. Well, that makes sense. I mean, any other things you wanted to just kind of chime in on for MSRs or
Yeah,
add?
one thing that I talk to people right now about is, especially with the potential for a recession coming along, it's just delinquencies. Delinquencies have been like historic lows for MSR. And, when you're at the bottom, there's kind of only one way to go, and that's up. And it's not something you can really hedge for, but you can definitely model it out to maybe be more conservative and drop your value down in anticipation of what it could be, or maybe even like discount that a little bit more, like maybe discount a subset of loans based off of credit scoring, to kind of get ahead of it. But I feel that could be that could be something that comes into play here if we go from a little bit of a softer landing to a harder landing.
I mean, have you seen any, I mean, probably not significant, but have you seen ticks up in delinquencies? I know there's a lot of talk in the FHA space that it seems to be, kind of starting to move that way. I mean, overall, have you seen?
Not a big move, no.
Okay, cool.
So it's I think I said it earlier, anticipation. I think it's another one of those kind of like anticipated items, that will come, potentially come down the line here.
Yeah, I mean, we see it. We start looking at things like credit cards, like credit card delinquencies are up, auto loan delinquencies are up. The credit cycle would tell you, right? FHA's next, government loans, and then conventional. So yeah, like you said, it's anticipatory that it's coming.
And if you think about it, if people get in trouble and they need to do loan mods, that's kind of, it can be a double hit, because if you have someone in a 3% loan that needs to do a modification, they're getting modded up to a high. Yeah, exactly. So kind of like a double whammy there for them.
Yeah. Okay. Well, that's great. Well, thank you again. Thank you for that. I guess just kind of jumping into the last topic here, 15 minutes or so, we may or may not use it all. Just overall, I guess over the last, and any of y'all could chime in on this, over the last, I don't know, year, especially the ones that have returned to profitability. I mean, what are you seeing that they're doing right? I mean, or like what just overall, just generally, it doesn't even, it can be specifically into the, execution stuff, MSRs, it can be outside of that. I mean, well, what are y'all seeing, the good companies doing right, I guess?
Yeah, I mean, it's all of those things. It's a lot of it unfortunately started with right sizing capacity. I think some folks did that sooner than others. Others took a bit longer out of, I think some of it was optimism, some of it was compassion, right? Just not wanting to put, good people out. So there was that. There's just generally being expense conscious, which this industry has always been really good at the ups and downs because we've had so many of them and they typically go so deep. And our industry is, no matter how creative and how aggressive you are, is always very much subject to interest rates, right? And policy and regulation. There's also just, good diversity in your hedge strategy, being smart about that. Getting back to the previous conversation, we saw a lot of clients liquidating MSRs to bring in cash during that time. I think honestly, I know less about MSRs than anybody on this call, but to me, there, we talk about a fair value versus what you can actually sell it for. To me, there's a margin between those two, and that's why one's usually higher than the other, especially in a market where people are motivated to sell. Why not put a bigger margin in there? I don't need to pay a 7 multiple for a portfolio from an independent mortgage bank if I know they're not making money. If I'm a buyer, I'm not a buyer, but if I was a buyer, so there's that piece of the strategy I think is important. And then if you go back to, and this obviously would be a lesson for next time, we have some clients and we've talked to a lot of lenders who built up reserves during the boom years, huge reserves. I mean, you can see some of them because it's public knowledge. It's publicly traded businesses built up millions or billions of dollars to subsidize margin over the past couple of years. So they've been able to compete more and get creative with pricing to pick up the 1.5 trillion kind of tiny group of volume that we've been seeing the past couple of years. And then I think some of the old playbook items too, like, bringing on originators, either luring originators from a competitor, consolidating with a competitor, bringing on origination from new sources, bringing on leads from new sources, the right kinds of leads, I think can be important as well. In a thin market, your leads are getting sold 10, 15 times over. So it's not, your traditional COVID era leads are not going to be nearly as valuable as they used to be. And they're probably more expensive. What else? What am I missing there, guys? I feel like, what have people been doing to just keep their heads above water?
Yeah, I mean, it's Jim hit on the main thing in the beginning about cutting costs. At various conferences I've been at, it's still, it's hard to say this, but people say, people probably are still not being aggressive enough in cutting headcount. Is the messages I've been seeing from other people around the industry, and it's hard to exactly see who has been most successful. People don't publicize that maybe nearly as much as is probably going on. Unfortunately, that is a big part of it. I don't think we're going to see, if people are holding out, holding on to people thinking there's going to be a huge increase in volume. I don't think a huge increase in volume is coming, even if rates drop, another half, 3/4 of a point, right? We're not going to see a huge pop. Some incremental increases, but I just don't think obviously we're not getting back to 2020 volumes at probably ever. So cutting costs, and then from there, it's all these incremental steps on top of it.
Yeah, I mean I'll chime in a little bit here. I mean that's what we saw people that cut early, cut a lot, and continue to do cuts. I mean I think I don't know. I mean I know going to the various conferences and stuff, the 3 or 4 years, like every conference, people are like, okay, I think we're done with cuts, and then there'd be another, it'd be nope, we gotta do a whole nother round of cuts. Mm-hmm. And I think that's really now you're seeing those people are seeing that, kind of the reward, I guess reward's probably a bad word, but the
effects of it, right?
Yes, the effects of it.
There's a lag, there's severance, there's multiple cuts. There was, when are we going to see the bottom? That was part of the problem, is you didn't know how deep to cut, right? We've all cut too far before. And again, we all have that optimism that for the last year and a half, we've all been saying 6 months from now, rates are going to be lower than they are now. And that hasn't happened yet. So yeah, yep. We're seeing the same thing. And again, hopefully we have seen the bottom finally. We have seen how deep it's going to go.
Got it. And I guess just kind of last, just closing thoughts here. I mean, any other tips that y'all have or y'all have seen just on, you know, whether it's how to manage margins, you know, analyze cost, analyze, where they're giving up, margin, stuff like that. I mean, any other just last minute kind of tips or thoughts for that for the group?
Data.
Yeah.
Yeah,
I
I
mean,
mean,
it's a great chance for you to lead us into a plug for some of our tools, right? We've got some good, certainly some good tools out of our PBE to look at where your competitive standing is relative to the market. Where your margins are, where your pricing is relative to the market. Look at trends over time. You can break that down and get relatively granular to see where you're getting and losing ground. You're probably never going to be the most competitive in the market. Whoever's most competitive is probably not pricing correctly, but making sure you're kind of staying in your sweet spot. So yeah, using data that's accessible. I think that's a big focus for us at OB is making sure the data, providing more and more tools to allow you to look at the data easier and make decisions quicker,
Well,
make
and
more strategic decisions.
I think also, I mean, I think on top of that is clean data or some data hygiene too. I mean,
mhm.
y'all can only do so much with what you have, but the data needs to be clean and needs to be, in the system, right? And yeah, so I mean, basically I feel basically that's what y'all's core focus is now is data. I mean, it's basically data and different various points and stuff like that. So having that data clean and good, so
Yeah, curated and unbiased, right?
yeah.
Like I go back. So before I was at OB, I was at a mortgage bank, and part of my job in secondary was um, rate surveys. I would go out, kind of create our own surveys, go out and find rate sheets, use survey services to get this data and actively manage exactly where our margins were. And this was coming out. I believe it's how we survived the great financial crisis, was just having that pricing in the right spot all the time. Not just to get the deals, but to bring in originators too. I worked for a shop that was always trying to bring on new originators, and we always had a price that we had a philosophy of keeping it in a very specific range that we knew was kind of optimally competitive. And back then it was still survey data, so it wasn't perfect because it was a little bit biased, it was a little bit voluntary, but just having the maximum amount of data to benchmark yourself against everybody else in the industry, especially in your MSAs and your different communities for the different kind of products you're trying to bring in, I think is a huge opportunity that I argue to say that a majority of mortgage bankers miss, even though they may know they're doing it, because there is a certain amount of influence that comes from the production staff in terms of what they can see and transparency into where loans are going and how they're being priced and all of that. But what that typically does is then it forces you as an independent mortgage bank for your pricing to be determined by the investors you're selling to versus purely based on your market and how you need to land loans. Does that make sense?
Yeah.
So you're like leaving it on autopilot is what 50% plus of independent mortgage banks do, but you're leaving cash on the table by doing that.
Yeah, I was gonna, tie that in just to kind of where we're at in the market right now, right? I feel like on this call we said a lot of this hasn't happened yet, right? We're kind of waiting for maybe something a little bit bigger to happen, right? Delinquencies haven't changed yet. Margins haven't increased yet. Volume hasn't really popped yet. So to Jim's point, right, you can't leave things on autopilot and look at things, once a quarter or, you got to be constantly looking at this stuff because, keep your head on a swivel because the market could change at any minute. And you got to be ready to respond and adapt.
Perfect. Tony, anything you want to add there?
No, I mean, I think everyone, kind of wrapped it up, for me. Only one little thing I would, just add is, MSR values are, pretty high right now. And, at this fall in rates, people may be surprised at, how quickly the even modeled rates, will drop. So if you're not thinking about hedging, you may want to for the MSR.
Perfect. Well, thank you. Okay. Well, with that, I think Casey, come back on. Jim, I literally had to look back up when you were not at Optimal Blue. So I was looking at LinkedIn to see how long ago that was that you were actually there, because you've been one of the faces over there for a long time, at least on the secondary side. So I was just having to figure that one out. So
12 and a half years roughly.
Yep. So, okay. Well, thank you guys. Thank you very much for doing this. Again, thank you for jumping on. Casey, you can kind of take it away.
Yeah, no, thank you guys all for jumping on and chatting through things that we hear on the forefront all the time. So that's a wrap. We are going to send out a survey at the end of this. If you guys could definitely take the survey, that would be really helpful. We're always trying to bring, content that's of value for everyone here.
Yeah.
Other than that, thank you, gentlemen, for joining.
All right.
Thanks for having us.
everybody.
Thank you all.
Thanks for having us, guys.
Thanks.
Thanks, guys.
Bye-bye.